Are you with me, Todd? Hi.
Yes, I am. How you doing, Lauren?
Nice to see you. Let's
Likewise.
just talk a little bit about yesterday. Lots of people were saying that finally, and it's about time, we finally saw that damage in the market. Investors reacted, people got scared, and we had that steep selling that we probably should have seen earlier and sooner. Since Friday when all these talks kind of fell through, the Dow's off some 400 points. So were you relieved to see that selling yesterday? I mean, would you expect more of it today? Go ahead.
I would expect more, actually, and I'm kind of surprised by the reaction today. I mean, granted, the jobless claims number was well, I would say better than expected, even though the revision was higher. And then, obviously, the home sales data, the pending home sales data was actually a nice surprise. Yeah. So I think that you're seeing a little bit of that. But, again, it's more of a churning process right now for the traders. We're really waiting to see what's going to happen with the debt talks, with the Boehner bill, and obviously with what Reid can come back with. So if there is resolution in Washington, that's great. But I think traders right now are really trying to prepare themselves for an ultimate downgrade, and that's probably going to be happening probably sometime in the next 72 hours.
Do you think the small gains that we're seeing right now on Wall Street are because of the better-than-expected pending home sales for last month and the jobless claims for last week? I mean, do you think that's
probably?
Yeah. And neither
of
those... Go ahead.
Well, volumes continue to be low, Lauren, as you know, and so there isn't a lot of conviction out there from traders on the bullish or bearish side. So right now you have this tug of war that's taking place, but realistically, though, everybody has all their eyes on D.C. right now. They want to see what's going to happen. That is the headline of the hour, obviously, and will continue that way well into the weekend.
And we're concerned to see, A, if we actually raise the debt ceiling, and then if we could fend off getting a downgrade by any of the credit agencies. And it seems like the latter of those two options is what everyone's more concerned about. But don't you think we're sick of talking about it at this point? I got tons of trader notes this morning, and it's like about time. Just get it done. There's nothing else to really think about or talk about.
Well, let me tell you something. You got a time bomb on Tuesday, obviously, with this thing going on. And everybody knows that we're going to get downgraded on the floor. The question is this. You have to ask yourself two questions. One, how much is the downgrade going to be? Are we going to double A or single A? And more importantly, how long is it going to take the United States of America to come back to AAA status? Look, if you look at the Boehner bill, you're looking at 6 months out. The Reid bill wants to take us past the election of next year. So realistically, though, we're talking about raising the debt ceiling to $16 trillion. And we could be talking about this again by the end of 2012, going to another $18 trillion. When you look at those numbers, you can't tell me that S&P and Moody's is not going to downgrade the U.S. of A. And if that's the case, that's where traders are really going to be concerned about right now. The debt ceiling, I think everybody agrees we're going to have a raise. Obviously, we're going to see something. But what's going to happen down the road, I think that's where the real concern is going to lie going forward for investors.
Yeah, and as you're talking, you're almost sounding the alarm bells. I want to watch the Dow Jones Industrial Average to see if it tanks on based on what you're saying, if only everybody could hear, because it really is scary when you think about it. And say we go from AAA to AA. Well, you know what kind of countries have a AA rating? Slovenia. Yeah. The United States would be on par with Slovenia. When you think about it like that, it really is scary. And we talk about all the repercussions all the time, and we say them ad nauseum. Interest rates are going up. We would increase, the debt and the borrowing that the United States carries when we can't even deal with what we have right now. So the people you talk to, what are they saying in terms of the strength of the U.S. economy? We've had tons of reports this week showing that there is pockets of weakness throughout the U.S. in manufacturing, a slowdown there. Obviously, the job market, even though claims went down below 400,000, there's still weakness. What are there, 5 applicants for every 1 job opening? How weak is the economy? And if all of this happens, could we sustain a downgrade and a default? Or is that, a cataclysmic Lehman Brothers financial fallout part 2?
Well, all of the above, Lauren. I mean, look, the macroeconomic data that's out there is horrible right now. You can only go back to the last 3 months and you'll see how bad it is. Look, you don't have the candy store that's open anymore in the form of quantitative easing. We have heard hints, obviously, during the first round of the Humphrey Hawkins testimony that Bernanke might entertain a QE3 option, but that realistically probably won't take place until the end of the year, if at all. So then you have to look at the GDP data. Look, if you go back to 1948, the rolling 12-month GDP data, if you dip below 2%, This country always ends up in a recession. That is right now standing at 2.3%. So look at it this way. You have zero steroids coming from the Fed right now. You have a big slowdown in the economy, a horrible jobs picture, and then you got all the looming stuff that's going on down in D.C. You can't tell me that we're not going to dip below 2% in the third quarter. If that's the case, we'll be back in recession territory by first quarter of 2012. The economy is horrible. The jobs number next Friday is going to be absolutely abysmal. Look for a negative jobs number on that side, and it's going to be bad. It's going to be really bad. Proceed with caution, buyer beware moving forward for equity investors.